The big win. How did Buffett make $1 billion in 24 hours? Imagine making $1 billion in a day. That's Warren Buffett, the Oracle of Omaha, doing what he does best: investing. On May 3, 2019, Buffett's Berkshire Hathaway saw its stock soar. By the end of the day, Buffett was $1 billion richer. It was good, old-fashioned investing with a Buffett twist. It was about patience, discipline, and a deep understanding of the market. This wasn't a fluke, it was a culmination of his investing philosophy. It's about long-term vision, calculated risks, and sticking to your guns. Buffett's story shows us that with the right approach, we can all learn to invest wisely and build wealth over time. The Oracle of Omaha, more than just luck. Warren Buffett isn't just lucky, he's a genius. He's been called the Oracle of Omaha for a reason. Buffett has a knack for seeing value where others don't. He's not afraid to go against the grain, buying when everyone else is selling and holding on for the long haul. His investment philosophy is simple but powerful. He buys great companies at fair prices and then holds on to them, sometimes for decades. This long-term perspective is what sets him apart from the pack. While others are busy chasing the latest hot stock, Buffett is content to let his investments compound over time. But Buffett's success isn't just about his investment strategy, it's also about his temperament. He's famously calm and rational even in the face of market turmoil. This allows him to make clear-headed decisions when others are panicking. Learning from the best Buffett's enduring lessons. Buffett's story is more than just a tale of financial success. It's a masterclass in investing, offering invaluable lessons for both seasoned investors and those just starting out. One of the biggest takeaways is the importance of patience. Buffett teaches us that true wealth is built over time, not overnight. Another crucial lesson is the power of value investing. Buffett's strategy of identifying undervalued companies with strong fundamentals is a timeless approach that continues to deliver results. He reminds us that investing isn't gambling. It's about owning a piece of a business and participating in its growth. Finally, Buffett's story highlights the importance of temperament in investing. His ability to remain calm and rational, even amidst market volatility, is a testament to his emotional intelligence. This underscores the need for investors to control their emotions and avoid making impulsive decisions based on fear or greed. The value hunter seeking out hidden gems. Warren Buffett doesn't follow the herd. He doesn't chase fads. He looks for value. He's like a detective, searching for clues in financial statements, market trends, and company leadership. He wants to understand the real worth of a business, not just its stock price. He looks for companies with a moat, a competitive advantage that protects them from rivals. This could be a strong brand, a loyal customer base, or a unique product. Think Coca-Cola's iconic brand or Apple's innovative products. He wants companies with staying power, not just flashes in the pan. Buffett is patient. He's willing to wait for the right opportunity, even if it takes years. He doesn't mind being early to the party. In fact, he prefers it. He buys when prices are low and others are fearful. He knows that value will eventually be recognized by the market. Section 2. Patience pays off. Buffett's long game. In the age of instant gratification, Buffett's patience is almost superhuman. He doesn't flinch at short-term market fluctuations. He's playing the long game, thinking in terms of decades, not days. This long-term perspective is crucial to his success. He understands that businesses take time to grow and compound their earnings. He's content to let his investments ride, reinvesting dividends and watching his wealth snowball over time. This approach requires discipline and a strong belief in your investment thesis. Buffett's patience isn't just about holding on to stocks, it's also about waiting for the right opportunities. He doesn't feel the need to constantly buy and sell. He's happy to sit on the sidelines, cash in hand, waiting for the perfect pitch. Section 3. Ignoring the noise, tuning out market hysteria. The stock market is a noisy place. Headlines scream about crashes and rallies. Pundits make predictions with absolute certainty. But Buffett doesn't listen to the noise. He tunes it out. He focuses on the fundamentals, not the hype. He knows that the market is driven by emotions in the short term. Fear and greed can cause wild swings in stock prices, often detached from underlying business realities. Buffett doesn't get caught up in the frenzy. He keeps his cool when others are losing their heads. Buffett's ability to ignore the noise is a testament to his discipline and independent thinking. He doesn't let the market dictate his emotions or his investment decisions. He sticks to his process, trusting his own analysis over the whims of the crowd. Section 4. Compounding, the eighth wonder of the world. Albert Einstein allegedly called compound interest the eighth wonder of the world. Warren Buffett would likely agree. Compounding is the engine that drives Buffett's wealth creation. It's the snowball effect of earning returns on top of previous returns. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, getting bigger and bigger. That's compounding in action. The longer the snowball rolls, the more massive it becomes. The same principle applies to investing. Buffett understands the power of time in compounding. The earlier you start investing and the longer you let your money work for you, the more dramatic the results. Even small amounts of money invested consistently over time can grow into significant wealth thanks to the magic of compounding. Section 5. Risk versus reward. Buffett's calculated approach. Warren Buffett is not a gambler, he's a calculated risk taker. He understands that every investment carries some degree of risk, but he doesn't shy away from risk entirely. Instead, he carefully assesses the potential downside and upside of every opportunity. He looks for what he calls a margin of safety, buying assets for significantly less than he believes they're worth. This provides a cushion against potential losses and enhances potential gains. It's like buying a dollar for 50 cents. Buffett's approach to risk management is a key factor in his long-term success. He understands that preserving capital is just as important as growing it. By meticulously evaluating risk and seeking a margin of safety, he minimizes potential losses and maximizes the odds of long-term success. Section 1. Banking on America, a bet on stability. Warren Buffett loves banks. He sees them as the bedrock of the American economy. They're essential to businesses and consumers alike. So it's no surprise that banks make up a significant chunk of Berkshire Hathaway's portfolio. One of his biggest bets has been on Bank of America. Buffett started buying Bank of America stock during the financial crisis of 2008, a time when many investors were running scared. He saw an opportunity to buy a great company at a deeply discounted price. His bet paid off big time. Bank of America recovered from the crisis and its stock price soared. Buffett's investment, initially worth billions, ballooned in value, contributing significantly to his billion-dollar day in 2019. Section 2. The apple of his eye, embracing tech titans. Warren Buffett was once wary of technology stocks. He preferred businesses he could easily understand, like banks and consumer goods companies. But even the Oracle of Omaha evolves. In recent years, he's embraced the tech sector, with Apple becoming one of Berkshire Hathaway's largest holdings. Why the change of heart? Buffett recognizes Apple's incredible brand loyalty, its massive cash flow, and its potential for continued growth. He sees Apple not just as a tech company, but as a consumer products giant, with a devoted customer base that rivals any other. Buffett's investment in Apple has been a home run. The stock has soared since he started buying it in 2016, making it one of his most profitable bets. It's a testament to his willingness to adapt his investment strategy as the market evolves.
Know you've been a good friend, and that's in the thick and thin. And I know it's never
Section 3. Consumer staples, the power of everyday brands. Warren Buffett loves companies that sell products people use every day. Think Coca-Cola, Kraft Heinz, and Procter & Gamble. These companies are staples in our lives, and their brands hold immense power. Buffett understands that people are creatures of habit. We tend to stick with the brands we know and trust, even during economic downturns. This makes consumer staples companies relatively recession-proof, providing a steady stream of earnings even when the economy stumbles. Berkshire Hathaway's portfolio is chock full of these consumer giants. These investments provide stability and consistent returns, anchoring his portfolio and allowing him to take calculated risks in other areas. Section 4. Berkshire Hathaway, investing in his own backyard. Warren Buffett doesn't just invest in other companies, he invests in his own. Berkshire Hathaway is more than just a holding company, it's a conglomerate with a diverse portfolio of wholly owned businesses. These businesses span a wide range of industries, from insurance and energy to railroads and manufacturing. This diversification provides Berkshire Hathaway with a stable earnings base, even when certain sectors of the economy are struggling. Buffett's investment in Berkshire Hathaway is a testament to his belief in his own company and its ability to generate value over the long term. He's essentially betting on himself and his team to outperform the market. Section 5. The power of cash, waiting for the right pitch. Warren Buffett is a patient investor, always willing to wait for the right opportunity, and he believes in being prepared when opportunity knocks. That's why Berkshire Hathaway always maintains a massive cash hoard, often exceeding $100 billion. This cash gives Buffett tremendous flexibility. He can swoop in and buy assets when others are forced to sell, often at bargain prices. It's like having a loaded gun in a duck hunt. You have to be ready when the ducks are in range. Buffett's cash pile is a source of both comfort and opportunity. It allows him to sleep well at night, knowing he has the financial firepower to weather any storm, and it positions him to capitalize on market downturns, buying undervalued assets that others are desperate to unload. May 3, 2019. Mark it on your calendars, folks. It wasn't just another day on Wall Street. It was the day Warren Buffett, the Oracle of Omaha, added a cool $1 billion to his already massive fortune. Not over a year, not over a month, but in a single trading day. Now, I know what you're thinking. Easy for him to say, Jim. He's already got more money than he can count. And you're right, Buffett's wealth is legendary. But what's remarkable about this particular day is how it exemplifies his investment philosophy in action. This wasn't about risky bets or insider trading. This was the culmination of decades of disciplined investing, of buying great companies and holding on for the long haul. May 3, 2019 was a testament to the power of patience, the magic of compounding, and the enduring wisdom of the Oracle himself. So, what happened on May 3rd that sent Berkshire Hathaway's stock into overdrive? Well, a few things aligned perfectly. First, Berkshire Hathaway, Buffett's investment vehicle, announced stellar earnings. Profits were up, businesses were booming, and investors were ecstatic. Second, the overall market was in a good mood. The economy was strong, interest rates were low, and investors were feeling optimistic about the future. This positive sentiment provided a tailwind for stocks across the board, including Berkshire Hathaway. But here's the kicker. Buffett had spent the previous months, even years, strategically accumulating shares of companies that were poised to benefit from these favorable economic conditions. He wasn't chasing the latest fad, he was playing chess while others were playing checkers. Now, you can't talk about May 3rd, 2019, without talking about the overall market sentiment. It was like everyone woke up feeling bullish that day. The economy was humming along, unemployment was low, and consumer confidence was high. This positive economic backdrop created a fertile ground for stock market growth. Investors were feeling confident, willing to put their money to work and ride the wave of optimism. And when the market gets a whiff of good news, especially when it comes to a blue-chip company like Berkshire Hathaway, it tends to react, well, enthusiastically. So, while Buffett's astute investments and Berkshire's strong performance were the primary drivers of his billion-dollar day, let's not discount the power of a bull market. It's like they say, a rising tide lifts all boats. And on May 3rd, Berkshire Hathaway was riding the crest of that wave. Section 4. The Buffett Effect. Confidence breeds confidence. Here's another factor to consider, the Buffett effect. Think about it, when Warren Buffett, the most respected investor of our time, makes a move, people notice. When Berkshire Hathaway reports blowout earnings, investors pay attention. Buffett's reputation as a shrewd, value-oriented investor precedes him. So when he puts his money to work, others are often quick to follow suit. It's a classic case of confidence breeding confidence. This isn't to say that investors blindly follow Buffett's every move. But his actions carry weight. They signal to the market that he sees value, that he believes in the long-term prospects of the companies he invests in. And that, my friends, can create a self-fulfilling prophecy, driving up stock prices and further enriching those who share his vision. Section 5. Beyond the billion, a legacy of value. $1 billion in a day is extraordinary, even for Warren Buffett. It's not a regular occurrence, even for the Oracle. Buffett's legacy isn't defined by any single day or investment. His true legacy lies in his enduring investment philosophy and commitment to value investing. May 3, 2019 was just a snapshot. The real lesson is about patience, discipline, and investing in quality companies. That's the Buffett way, a roadmap for success any investor can follow. Section 1. A lifetime of wins beyond the billion-dollar day. Okay, so May 3, 2019 was a banner day for Buffett. $1 billion in 24 hours, that's the stuff of legend. But let's not forget, this wasn't some lucky streak or a one-hit wonder. Buffett's been racking up wins for decades. His track record is astonishing. He's consistently outperformed the market, turning Berkshire Hathaway into an investment powerhouse. But what's even more impressive is the diversity of his successes. From newspapers to insurance giants, from tech titans to candy companies, Buffett's got a knack for spotting value in the most unexpected places. What's the secret sauce? It's not about chasing fads or timing the market perfectly. It's about understanding the fundamentals of business, identifying companies with a durable competitive advantage, and then having the patience to let those investments compound over time. Section 2. The Washington Post. A bet on journalism's enduring value. Back in the 1970s, when Buffett first invested in the Washington Post, people thought he'd lost his touch. Newspapers, print media, in the age of television, it seemed like a dying industry. But Buffett saw something others didn't. He recognized the power of the Post brand, its journalistic integrity, and its deep connection with readers in the Washington, D.C. area. He understood that even in a changing media landscape, quality journalism would always have value. And boy was he right. The Post, under the leadership of Katharine Graham, whom Buffett deeply admired, not only survived but thrived. It broke major stories like Watergate, solidified its reputation as a leading national newspaper, and delivered substantial returns for Berkshire Hathaway. Section 3. Geico Insurance as a cash cow. Now, insurance might not sound like the sexiest industry, but it's been a goldmine for Buffett. His investment in Geico, the auto insurance giant, is a prime example of his ability to spot a cash-generating machine. See, insurance is all about collecting premiums up front and paying out claims later. This creates a pool of money that insurers can invest while they wait for claims to roll in. Geico, with its low-cost model and direct-to-consumer approach, has been exceptionally good at generating this float. Buffett recognized Geico's potential early on, gradually increasing his stake in the company until Berkshire Hathaway eventually owned it outright. This long-term investment has provided Berkshire with a steady stream of cash flow, fueling further investments and bolstering its overall returns. Section 4. Coca-Cola, the real thing for long-term growth. Ah, Coca-Cola. The quintessential American brand, the beverage giant that's quenched our thirst for generations. It's also one of Buffett's all-time favorite investments. Why? Because Coca-Cola is a classic example of a company with a wide moat. Think about it, Coke's brand recognition is global, its distribution network is unmatched, and its secret formula, while often imitated, has never been duplicated. This gives Coke incredible pricing power and a loyal customer base that spans continents. Buffett started buying Coke stock in the late 1980s, accumulating a massive stake in the company that he's largely held onto ever since. This investment has been a steady performer for Berkshire Hathaway, generating both dividends and capital appreciation over the decades. Section 5. CES Candies. A sweet spot in the portfolio. Now here's an example that shows Buffett's playful side. CES Candies, the beloved maker of chocolates and other sweet treats, might seem like an odd fit for Berkshire Hathaway's portfolio. But this investment has been a sweet deal for Buffett, both financially and personally. CES Candies, with its nostalgic brand and loyal following, has a few things going for it. First, it has strong pricing power. People are willing to pay a premium for CES chocolates, especially around holidays like Valentine's Day and Christmas. Second, it's a relatively capital-light business. CES doesn't need to invest heavily in factories or equipment to churn out its chocolates. This means it generates a lot of cash that can be reinvested or returned to shareholders. Buffett has often cited CES Candies as an example of a simple, profitable business with a durable competitive advantage. Plus, he admits to having a bit of a sweet tooth, so there's that. Section 1. The Buffett Blueprint, Timeless Principles for Every Investor. So there you have it, folks. The tale of how Warren Buffett made $1 billion in a single day. It's a story that captures the imagination, sparking dreams of financial freedom and market-crushing returns. But let's be real, not everyone's going to wake up a billionaire, even after reading this essay. But here's the good news. Buffett's success isn't some closely guarded secret. It's not about having a crystal ball or insider connections. It's about following a set of principles, a blueprint for investing success that's been tested by time and proven effective over decades. And the best part? This blueprint is available to anyone willing to study it, internalize it, and apply it with discipline and patience. You don't need a fancy MBA or a Wall Street pedigree. You just need the right mindset, the right approach, and the willingness to play the long game. Section 2. Patience, the investor's superpower. If there's one takeaway from Buffett's story, it's this. Patience is not just a virtue, it's an investor's superpower. In a world obsessed with instant gratification, where everyone wants to get rich quick, Buffett stands as a beacon of calm, reminding us that true wealth is built brick by brick, not overnight. Think of it like planting a tree. You wouldn't dig it up every few weeks to see if it's grown, would you? No, you'd nurture it, water it, and give it time to take root and flourish. Investing is no different. You've got to plant your seeds, choose your investments wisely, and then give them time to grow. Ignore the market noise, tune out the short-term fluctuations, and trust in the power of compounding to work its magic over the long haul. Section 3. Value over hype. Ignore the noise, trust the fundamentals. Wall Street is a noisy place. Every day we're bombarded with headlines, predictions, and hot stock tips. It's enough to make anyone's head spin. But Buffett teaches us to drown out the noise and focus on what really matters: value. Don't get swept up in the latest fads or chase after get-rich-quick schemes. Instead, take a page from Buffett's playbook and become a value investor. Learn to analyze businesses, understand their competitive landscape, and identify those with a durable moat, a sustainable advantage that protects their profits. Look for companies with strong management teams, solid financials, and a history of profitability. These are the businesses that can weather economic storms and deliver long-term value to their shareholders. Section 4. The long game. Compounding your way to wealth. Albert Einstein reportedly called compound interest the eighth wonder of the world, and Warren Buffett would likely agree. Compounding is the engine that drives long-term wealth creation. It's the snowball effect of earning returns on top of previous returns, year after year, decade after decade. The earlier you start investing and the longer you let your money compound, the more dramatic the results. Even small amounts, invested consistently over time, can grow into significant wealth thanks to the magic of compounding. So start early, invest regularly, and let time be your ally. Remember, Rome wasn't built in a day, and neither is a fortune. Embrace the long game and let compounding work its wonders. Section 5. Risk and reward. Balancing prudence with opportunity. Now, I'm not saying you should avoid risk altogether. Investing always involves some degree of risk. But Buffett teaches us to be calculated risk takers. Don't be reckless with your hard-earned money. Before you invest, do your homework. Understand the potential downsides as well as the upsides. Look for a margin of safety, buying assets for significantly less than you believe they're worth. This provides a cushion against potential losses and enhances your potential gains. Remember, investing isn't gambling. It's about owning a piece of a business and participating in its long-term success. So, be selective, be patient, and always prioritize the preservation of your capital. The legacy of the Oracle inspiring generations of investors. Warren Buffett's legacy extends far beyond his billions. He's a teacher, a mentor, and an inspiration. His principles of value investing, patience, and disciplined decision-making resonate with investors. He's shown us that success in the market is possible without compromising integrity. He's a testament to long-term thinking and aligning investments with values. Remember the lessons of the Oracle of Omaha. Be patient, disciplined, and value-oriented.